Introduction to real estate tax. Real estate taxation is a complex but crucial aspect of successful investing, directly impacting profitability and long-term wealth accumulation. Understanding the fundamental tax principles applicable to real estate is the first step towards mastering strategic tax planning. This introductory section lays the groundwork by defining key terms and outlining the general tax landscape for property owners. Investors must recognize that every real estate transaction, from acquisition to disposition, carries significant tax implications. Proper planning can transform potential tax liabilities into opportunities for wealth preservation and growth. Ignoring these aspects can lead to substantial financial losses and missed opportunities. Therefore, a proactive approach to tax strategy is indispensable for any serious real estate investor. The U.S. tax code, specifically, offers numerous provisions that can benefit real estate investors, provided they know how to leverage them. These provisions often relate to income generation, expense deductions, and capital gains treatment. Familiarizing oneself with these basic concepts will enable investors to make informed decisions and begin to identify areas for tax optimization. This course will guide you through these intricacies, ensuring you gain a comprehensive understanding of how to minimize your tax burden legally and effectively. It emphasizes the importance of meticulous record keeping and staying updated on evolving tax laws to maintain compliance and maximize benefits. Understanding taxable income. Taxable income from real estate investments primarily includes rental income, capital gains from sales, and sometimes income from property flipping. It is crucial to accurately calculate gross rental income, which encompasses all payments received from tenants, including rent, security deposit forfeitures, and payments for tenant-paid expenses. Understanding what constitutes taxable income is the foundation for applying deductions and credits effectively. Miscalculating this figure can lead to either underpayment or overpayment of taxes, both of which have undesirable consequences. Therefore, diligent tracking of all income streams is paramount for accurate tax reporting. This ensures compliance and maximizes the benefits of available tax strategies. Conversely, certain income streams might be exempt or deferred under specific tax provisions, such as the Section 121 exclusion for primary residences or gains deferred through a 1031 exchange. Differentiating between taxable and non-taxable income is a key skill for real estate investors. This distinction allows for strategic planning regarding when and how to realize gains or losses. A thorough understanding of these nuances helps investors optimize their tax position and avoid unnecessary tax burdens. It also enables them to leverage tax-advantaged strategies for long-term wealth building. Depreciation basics for real estate. Depreciation is a non-cash expense that allows real estate investors to recover the cost of income-producing property over its useful life. It is a powerful tax deduction that reduces taxable income without requiring an actual cash outflow. Understanding how to calculate and apply depreciation correctly is fundamental for maximizing tax benefits. The IRS sets specific recovery periods for different types of real estate. Typically, 27.5 years for residential rental property and 39 years for non-residential property. This deduction helps offset rental income, significantly lowering an investor's overall tax liability. It is a critical component of real estate tax planning. To calculate depreciation, investors must first determine the property's depreciable basis, which is generally the cost of the building and any improvements, excluding the value of the land. The straight-line method is the most common approach, spreading the deduction evenly over the recovery period. Accurate record-keeping of property costs and improvements is essential for claiming the correct depreciation amount. This tax strategy effectively reduces net taxable income, making real estate an even more attractive investment. Proper application of depreciation can lead to substantial tax savings year after year, enhancing cash flow and investment returns. Cost segregation strategies. Cost segregation is an advanced tax strategy that accelerates depreciation deductions by reclassifying certain components of a building from real property to personal property. This allows investors to depreciate these components over shorter recovery periods, typically 5, 7, or 15 years, instead of the standard 27.5 or 39 years. The immediate benefit is a significant increase in depreciation deductions in the early years of property ownership, leading to substantial tax savings and improved cash flow. This strategy is particularly effective for newly constructed buildings or recently acquired properties. A cost segregation study involves a detailed analysis of a property's construction costs and components by qualified professionals. They identify elements like electrical systems, plumbing, carpeting, and landscaping that can be reclassified. The study provides a comprehensive report supporting the accelerated depreciation claims to the IRS. Implementing cost segregation requires expertise, but can yield substantial tax advantages, making it a powerful tool for sophisticated real estate investors. It is a proactive approach to tax management that can significantly enhance investment returns and reduce tax liabilities. Passive activity loss rules. The IRS's passive activity loss (PAL) rules limit the ability of investors to deduct losses from passive activities, such as rental real estate, against non-passive income like salaries or business profits. A passive activity is generally one in which the taxpayer does not materially participate. Understanding these rules is critical because disallowed passive losses can be carried forward indefinitely and used in future years when passive income is generated or when the activity is disposed of. This limitation prevents investors from using real estate losses to shelter active income, making strategic planning essential. Material participation is key to avoiding PAL limitations. The IRS defines several tests for material participation, including spending more than 500 hours in the activity or being the sole participant. If an investor qualifies as a real estate professional, they can often deduct passive losses against active income, which is a significant tax advantage. This status requires meeting specific hour thresholds in real property, trades, or businesses. Navigating PAL rules effectively requires careful tracking of time and activities, along with a clear understanding of the IRS criteria. Proper planning can unlock substantial tax benefits for active real estate investors. Real estate professional status. Achieving real estate professional (REP) status is a powerful tax strategy for investors, allowing them to deduct passive real estate losses against active income. This status bypasses the passive activity loss limitations that typically restrict such deductions. To qualify, an individual must meet two stringent tests. First, more than half of their personal services performed in trades or businesses during the tax year must be in real property trades or businesses where they materially participate. Second, they must perform more than 750 hours of services in real property trades or businesses in which they materially participate during the tax year. These thresholds are strictly enforced by the IRS. The definition of real property trades or businesses includes development, redevelopment, construction, reconstruction, acquisition, conversion, rental, operation, management, leasing, or brokerage of real property. Spouses can combine their hours to meet the 750-hour test, but only one spouse needs to meet the more than half of personal services test. Maintaining meticulous records of time spent on real estate activities is absolutely crucial for substantiating REP status in case of an IRS audit. This status can significantly reduce an investor's overall tax burden making it a highly sought-after qualification for active real estate professionals. 1031 Exchange Fundamentals. A 1031 exchange, also known as a like-kind exchange, allows real estate investors to defer capital gains taxes when selling an investment property and reinvesting the proceeds into another like-kind property. This powerful tax deferral strategy enables investors to continuously roll over their equity into new investments without incurring immediate tax liabilities. The key benefit is the ability to preserve capital and compound returns over time, accelerating wealth accumulation. Understanding the strict rules and timelines associated with a 1031 exchange is paramount for successful execution. There are specific requirements for a valid 1031 exchange. The relinquished property and the replacement property must be held for productive use in a trade or business or for investment. Both properties must be like-kind, which generally means real property for real property, regardless of whether it's improved or unimproved. Crucially, investors must identify potential replacement properties within 45 days of selling the relinquished property and acquire one or more of those identified properties within 180 days. Using a qualified intermediary, QI, is mandatory to hold the sale proceeds and ensure proper handling of the exchange. Failure to meet these deadlines or requirements can invalidate the exchange, triggering immediate capital gains taxes. Advanced 1031 exchange scenarios beyond the basic forward exchange. Real estate investors can explore more complex 1031 exchange structures to meet specific investment goals. A reverse exchange, for instance, allows an investor to acquire the replacement property before selling the relinquished property. This is particularly useful when an ideal replacement property becomes available quickly, but the investor hasn't yet found a buyer for their current property. However, reverse exchanges are more complex and typically involve an exchange accommodation title holder, EAT, to park one of the properties temporarily, adding layers of cost and complexity. Another advanced scenario is a build-to-suit or construction exchange, where the investor uses exchange funds to construct improvements on the replacement property. This allows for significant value addition while still deferring capital gains. Partial exchanges are also possible, where only a portion of the gain is deferred, and the remaining, non-like-kind property received, is taxed. Understanding these advanced scenarios requires careful planning and often the guidance of experienced tax and legal professionals. Each scenario has unique rules and potential pitfalls that must be meticulously navigated to ensure tax deferral. These strategies offer flexibility but demand a higher level of expertise. Opportunity Zones Investment. Opportunity zones are economically distressed communities where new investments, under certain conditions, are eligible for preferential tax treatment. This program encourages long-term investments in these areas by offering 3 significant tax benefits to investors who reinvest capital gains into qualified opportunity funds, QOFs. The first benefit is the deferral of capital gains tax on the original investment until the earlier of the date the investment is sold or exchanged, or December 31st, 2026. This deferral provides immediate cash flow advantages and allows capital to remain invested longer. The second benefit is a step up in basis for the deferred capital gains. If the investment in the QOF is held for at least 5 years, the basis of the original capital gain is increased by 10%. If held for 7 years, the basis is increased by an additional 5%, totaling a 15% step up. The most powerful benefit is the permanent exclusion of capital gains tax on the appreciation of the QOF investment itself, provided the investment is held for at least 10 years. This means any gains generated from the QOF investment after 10 years are tax-free. Opportunity zones present a unique chance for investors to combine social impact with significant tax advantages, making them a compelling strategy for long-term wealth building. Capital gains tax management. Managing capital gains tax is a cornerstone of effective real estate investment strategy. Capital gains arise when an asset, such as an investment property, is sold for more than its adjusted basis. These gains are typically categorized as either short-term, held for 1 year or less, or long-term, held for more than 1 year, with long-term capital gains generally taxed at lower preferential rates. Understanding the difference and strategically timing sales can significantly impact the tax liability. Investors should always aim for long-term capital gains treatment whenever feasible to minimize their tax burden. Several strategies exist to manage capital gains tax effectively. Beyond the 1031 exchange and opportunity zones, investors can utilize capital loss harvesting, where losses from other investments are used to offset capital gains. Another approach involves holding properties for longer periods to qualify for long-term capital gains rates. Additionally, installment sales can spread the recognition of gains over multiple tax years, potentially keeping the investor in a lower tax bracket. For primary residences, the Section 121 exclusion allows a significant portion of gain to be excluded from taxable income. Each strategy requires careful consideration of individual circumstances and investment goals to optimize tax outcomes. Section 121 exclusion, primary residence. The Section 121 exclusion is a significant tax benefit for homeowners selling their primary residence. It allows individual taxpayers to exclude up to $250,000 of capital gain from the sale, while married couples filing jointly can exclude up to $500,000. This exclusion can be used repeatedly, provided the taxpayer meets specific ownership and use tests. It is a powerful tool for wealth building through homeownership, as it significantly reduces or eliminates capital gains tax on the sale of a personal home. Understanding its requirements is crucial for maximizing this benefit. To qualify for the Section 121 exclusion, the taxpayer must meet both the ownership test and the use test. The ownership test requires that the taxpayer owned the home for at least 2 years during the 5-year period ending on the date of sale. The use test requires that the taxpayer lived in the home as their main home for at least 2 years during the same 5-year period. These 2 years do not need to be continuous. There are also exceptions for unforeseen circumstances, such as job changes, health issues, or other qualifying events, which may allow a partial exclusion even if the full tests are not met. Proper documentation of ownership and residency is essential for claiming this valuable exclusion. Deductible expenses for rentals. Real estate investors can significantly reduce their taxable rental income by deducting various ordinary and necessary expenses incurred in operating their rental properties. These deductions directly lower the net income subject to tax, thereby reducing the overall tax liability. Common deductible expenses include mortgage interest, property taxes, insurance premiums, utilities paid by the landlord, and professional fees for property management, legal, or accounting services. Keeping meticulous records of all expenses is crucial for substantiating these deductions during tax season. This proactive approach ensures compliance and maximizes tax savings. Other important deductible expenses encompass advertising costs for vacancies, cleaning and maintenance fees, repairs, not improvements, supplies, and travel expenses related to managing the property. Depreciation, as discussed earlier, is also a major non-cash deduction. It is vital to distinguish between repairs, which are immediately deductible, and improvements, which must be capitalized and depreciated over time. Understanding this distinction is key to proper tax treatment. Maximizing these deductions is a fundamental strategy for increasing the profitability of rental real estate investments and improving cash flow. Mortgage interest deduction. The mortgage interest deduction is one of the most significant tax benefits for real estate investors, allowing them to deduct the interest paid on loans used to acquire or improve rental properties. This deduction directly reduces taxable rental income, thereby lowering the investor's overall tax liability. For most rental properties, there are no limits on the amount of mortgage interest that can be deducted, unlike the limitations for personal residences. This makes leveraging debt a powerful strategy for tax optimization in real estate. Understanding this deduction is fundamental for maximizing returns. It is crucial to differentiate between interest paid on loans for rental properties and interest paid on personal home mortgages. While both can be deductible, the rules and limitations differ. For rental properties, the interest is considered a business expense and is fully deductible against rental income. Accurate record keeping of all interest payments, typically provided on Form 1098 from the lender, is essential for claiming this deduction. This deduction effectively lowers the cost of borrowing and enhances the profitability of income-generating real estate. It is a key component of a comprehensive tax strategy for real estate investors. Property tax deductions. Property taxes, also known as real estate taxes, are another significant deductible expense for real estate investors. These taxes are assessed by local government authorities based on the value of the property and are typically paid annually or semi-annually. For rental properties, property taxes are fully deductible against rental income, reducing the investor's taxable income and overall tax burden. This deduction is a substantial benefit, especially in areas with high property values and corresponding high tax rates. Understanding how to track and claim this deduction is essential for optimizing tax outcomes. It is important to note the distinction between property taxes for rental properties and those for a primary residence. While property taxes for a primary residence are also deductible, they are subject to the state and local tax SALT deduction limitation, which caps the deduction at $10,000 per household. For rental properties, property taxes are considered an ordinary and necessary business expense and are not subject to this SALT limitation. Accurate record keeping of all property tax payments, often found on property tax bills or settlement statements, is crucial for proper reporting. Maximizing this deduction is a straightforward yet powerful way to enhance the profitability of real estate investments. Home office deductions. Real estate investors who use a portion of their home exclusively and regularly for their real estate business may be eligible for the home office deduction. This deduction allows investors to write off a portion of their home expenses, such as mortgage interest, property taxes, utilities, and insurance, against their business income. It can be a valuable tax saving, especially for investors who actively manage their properties from home. Understanding the strict IRS requirements for this deduction is essential to avoid potential audit triggers. The home office must be the principal place of business or a place where the taxpayer meets clients, patients, or customers in the normal course of business. There are two main methods for calculating the home office deduction: the regular method and the simplified method. The regular method involves calculating the actual expenses attributable to the home office, typically based on the percentage of the home square footage used for business. The simplified method offers a standard deduction of $5 per square foot for up to 300 square feet, capped at $1,500 per year. While simpler, it may result in a smaller deduction than the actual expense method. Choosing the right method depends on the investor's specific circumstances and the actual costs incurred. accurate record-keeping of all home-related expenses, and the dedicated business space is crucial for claiming this deduction successfully. Rehab and repair deductions. Distinguishing between repairs and improvements is critical for real estate investors, as their tax treatment differs significantly. Repairs are expenses incurred to maintain a property in good operating condition, such as fixing a leaky faucet, patching a hole in a wall, or repainting. These are generally considered ordinary and necessary business expenses and are fully deductible in the year they are incurred. Properly categorizing repairs can lead to immediate tax savings by reducing current taxable income. Meticulous record-keeping of all repair expenses is essential for substantiation. Improvements, on the other hand, are expenses that add value to the property, prolong its useful life, or adapt it to a new use, such as adding a new room, replacing an entire roof, or upgrading a kitchen. Improvements are not immediately deductible, but must be capitalized and depreciated over the property's useful life. The de minimis safe harbor rule allows businesses to expense certain low-cost items that would otherwise be capitalized, typically up to $2,500 per item or invoice. Understanding these rules helps investors optimize their tax strategy, accelerating deductions when possible, and correctly capitalizing long-term investments. This distinction is a frequent area of IRS scrutiny, so accurate classification is paramount. Refinancing tax implications. Refinancing a rental property can have various tax implications that investors must understand. Generally, the principal amount of a refinanced loan is not considered taxable income. However, the interest paid on the new loan remains deductible, similar to the original mortgage interest, provided the loan proceeds are used for business or investment purposes related to the rental property. If the refinanced funds are used for personal expenses, the interest on that portion of the loan may not be deductible. This distinction is crucial for maintaining the tax benefits of mortgage interest. Cash-out refinancing, where an investor takes out a new loan for more than the outstanding balance of the old loan and receives the difference in cash, also has specific tax considerations. The cash received is generally not taxable income at the time of refinancing. However, if the cash-out funds are used to improve the rental property, the interest on that portion of the loan is deductible. If used for other investments, the interest may be deductible as investment interest expense. If used for personal expenses, the interest is not deductible. Understanding these nuances allows investors to strategically use refinanced funds while preserving or maximizing their tax deductions. Careful tracking of how funds are used is paramount. Estate planning and real estate. Integrating real estate into a comprehensive estate plan is crucial for ensuring a smooth transfer of assets and minimizing tax burdens for heirs. Proper estate planning can help avoid probate, reduce estate taxes, and provide for the orderly distribution of properties according to the investor's wishes. Without a well-structured plan, real estate assets can become subject to lengthy and costly probate processes, potentially diminishing their value for beneficiaries. This proactive approach protects wealth and ensures a lasting legacy. Key strategies include placing properties into trusts, which can bypass probate and offer asset protection. Different types of trusts, such as revocable living trusts or irrevocable trusts, offer varying levels of control and tax benefits. Gifting properties during one's lifetime can also reduce the size of the taxable estate, though gift tax rules must be carefully considered. Understanding the step-up in basis rule at death is also vital, as it allows heirs to inherit property at its fair market value on the date of death, potentially eliminating capital gains tax on prior appreciation. Consulting with estate planning attorneys and tax advisors is essential to create a tailored plan that aligns with individual goals and minimizes future tax liabilities. Gift tax considerations. Gifting real estate can be an effective estate planning strategy to reduce the size of a taxable estate and transfer wealth to heirs. However, investors must be aware of federal gift tax rules. The IRS allows an annual gift tax exclusion, which means an individual can give away a certain amount of money or property each year to any number of recipients without incurring gift tax or using up their lifetime exemption. For 2024, this annual exclusion is $18,000 per recipient. Married couples can combine their exclusions, effectively gifting $36,000 per recipient annually. Gifts above this amount generally count against the donor's lifetime gift and estate tax exemption. The lifetime gift and estate tax exemption is a cumulative amount that an individual can give away during their lifetime or at death, without incurring federal gift or estate tax. For 2024, this exemption is $13.61 million per individual. Gifting appreciated real estate can be complex, as the recipient generally takes on the donor's original basis. This means if the property is later sold by the recipient, they may face a significant capital gains tax liability. Strategic gifting often involves considering the recipient's tax situation and the potential for a step-up in basis at death versus the benefits of reducing the donor's taxable estate. Professional guidance is essential to navigate these complex rules and optimize gifting strategies. Self-employment tax for investors. Real estate investors who are actively involved in their real estate business, particularly those who qualify as real estate professionals or engage in property flipping, may be subject to self-employment tax. Self-employment tax is a tax consisting of Social Security and Medicare taxes, primarily for individuals who work for themselves. It is similar to the Social Security and Medicare taxes withheld from the pay of most wage earners. For real estate investors, this tax applies to net earnings from self-employment, which can include income from services provided, such as property management fees or brokerage commissions, and potentially profits from property flipping, if it's considered a trade or business. Rental income by itself is generally not subject to self-employment tax, unless the investor provides substantial services to tenants beyond what is typically expected of a landlord. However, if an investor's real estate activities rise to the level of a trade or business, such as actively buying, renovating, and selling properties, flipping, the net profits from these activities could be subject to self-employment tax. Understanding when and how self-employment tax applies is crucial for accurate tax planning and avoiding unexpected liabilities. Proper classification of income and activities is key, and consulting with a tax professional can help determine the correct tax treatment for specific investment scenarios. Entity selection for tax benefits. Choosing the right legal entity for real estate investments is a critical decision that significantly impacts tax benefits, liability protection, and administrative burden. Common entity structures include sole proprietorships, partnerships, limited liability companies, LLCs, and S corporations. Each structure offers distinct advantages and disadvantages from a tax perspective. For instance, a sole proprietorship is simple but offers no personal liability protection and subjects all profits to self-employment tax. Understanding these differences is fundamental to strategic tax planning. LLCs are a popular choice for real estate investors due to their liability protection and flexibility in taxation. An LLC can be taxed as a sole proprietorship, disregarded entity, partnership, or even an S corporation, depending on elections made with the IRS. S corporations can offer self-employment tax savings by allowing owners to pay themselves a reasonable salary and distribute remaining profits as non-self-employment income. Partnerships are suitable for co-investors, allowing for pass-through taxation. C corporations are generally less common for real estate due to double taxation, but can be advantageous in specific scenarios. The optimal entity choice depends on the investor's goals, number of partners, and desired level of liability protection. Consulting with legal and tax professionals is essential to select the most advantageous structure. Understanding basis and adjustments. The basis of a real estate property is its cost for tax purposes, serving as the benchmark for calculating depreciation, capital gains, and losses. Initially, the basis is typically the purchase price plus certain acquisition costs, such as closing costs, legal fees, and title insurance. Understanding the initial basis is fundamental as it directly impacts future tax calculations. Without an accurate basis, investors cannot correctly determine their taxable gain or deductible loss upon sale, nor can they properly calculate depreciation deductions during ownership. This concept is central to all real estate tax strategies. Throughout the ownership period, the property's basis is subject to various adjustments. It increases with capital improvements, such as adding a new roof or renovating a kitchen, and decreases with depreciation deductions taken over time. These adjustments create the adjusted basis. When the property is sold, the capital gain or loss is calculated by subtracting the adjusted basis from the net sale price. Maintaining detailed records of all acquisition costs, improvements, and depreciation taken is absolutely critical for accurately determining the adjusted basis. Proper tracking ensures that investors can fully leverage tax benefits and accurately report their financial outcomes. This meticulous record-keeping is a non-negotiable aspect of effective real estate tax management. Tax credits for real estate. Beyond deductions, real estate investors can also benefit from various tax credits, which directly reduce their tax liability dollar for dollar, making them even more valuable than deductions. Tax credits are typically authored to encourage specific types of investments or activities that align with public policy goals. Understanding and identifying eligible tax credits can significantly enhance the profitability of certain real estate projects. These credits can include those for historic rehabilitation, low-income housing, and renewable energy. It is crucial to research and understand the specific requirements for each credit. The Historic Rehabilitation Tax Credit, for example, provides a 20% credit for the rehabilitation of certified historic structures. The Low-Income Housing Tax Credit, LIHTC, is another powerful incentive for developing affordable housing, offering credits over a 10-year period. Renewable energy tax credits, such as those for solar or geothermal installations, can also apply to rental properties. While these credits often come with complex rules and compliance requirements, the financial benefits can be substantial. Investors should consult with tax professionals specializing in these areas to determine eligibility and maximize the use of available credits. Proactively seeking out and applying for these credits can dramatically improve investment returns and reduce tax burdens. State and local tax (SALT) issues. Real estate investors must also consider state and local tax (SALT) implications, as these can significantly impact overall profitability. Beyond federal taxes, properties are subject to state income taxes, local property taxes, and sometimes other specific local levies. The deductibility of these state and local taxes on federal returns is subject to certain limitations, particularly the $10,000 SALT cap for individuals, which applies to property taxes and state income/sales taxes. While this cap primarily affects primary residences, investors need to understand how it interacts with their overall tax picture. For rental properties, state and local property taxes are generally fully deductible as business expenses against rental income, not subject to the $10,000 SALT cap. However, state income taxes on rental income are still subject to the cap. Some states have specific real estate transfer taxes, recording fees, or other local assessments that must be factored into transaction costs and tax planning. Understanding the specific tax laws in each state and locality where properties are owned is crucial. These vary widely, and what is deductible or taxable in one jurisdiction may not be in another. Consulting with local tax professionals is essential to navigate these complex and varied state and local tax landscapes effectively. Audit preparedness and best practices. Being prepared for a potential IRS audit is a critical aspect of mastering tax strategies for real estate investors. While no one wants to be audited, having meticulous records and understanding common audit triggers can significantly ease the process and improve outcomes. The best defense against an audit is a strong offense. Maintaining impeccable financial records, including all income statements, expense receipts, depreciation schedules, and transaction documents. Organized and easily accessible documentation is paramount for substantiating all claims made on a tax return. This proactive approach minimizes stress and potential penalties. Common audit triggers for real estate investors include large deductions relative to income, consistent passive losses, claiming real estate professional status without sufficient documentation, and errors in 1031 exchanges. Best practices involve using dedicated bank accounts for each property, utilizing accounting software to track income and expenses, and retaining all supporting documents for at least 3 to 7 years. Regularly reviewing financial records and tax returns for accuracy before filing can also catch potential issues. If an audit does occur, remaining calm, providing only the requested information, and seeking professional representation from a tax attorney or CPA are essential steps. Proactive organization and diligent record keeping are the investor's greatest allies. Future tax law changes and planning. Tax laws are dynamic and subject to frequent changes, making it imperative for real estate investors to stay informed and adapt their strategies accordingly. Legislative proposals, economic shifts, and political priorities can all influence future tax policies affecting depreciation, capital gains, passive activity losses, and other key areas. Proactive monitoring of these potential changes allows investors to anticipate impacts and adjust their long-term planning. Relying on outdated information can lead to missed opportunities or unexpected tax liabilities. Continuous education and engagement with tax policy discussions are vital for sustained success. Effective future tax planning involves scenario analysis, where investors consider how different proposed tax changes might affect their portfolio and develop contingency plans. This might include accelerating or deferring income and expenses, reevaluating entity structures, or adjusting investment timelines. Building strong relationships with knowledgeable tax advisors and legal professionals is invaluable, as they can provide insights into potential legislative developments and help interpret complex new rules. Staying agile and informed is not just about compliance, it's about maintaining a competitive edge and optimizing wealth accumulation in an ever-evolving tax landscape. Strategic investors view tax law changes not as obstacles, but as opportunities for adaptation and innovation.